Welcome, everybody. Thank you for your patience. I know we're a couple minutes late in here. I had to catch Jimmy and Logan up on some stuff we're dealing with at Gust right now, but I'm very happy to have Logan back for another webinar all around financial forecasting. This is the one that we often call as like the boring but important one, where it's, making forecasts for investors, to get an idea of your business model, to prove it, to excite you about where your company's going is a lot of fun. But if you don't touch the model after that, it generally doesn't help your business beyond maybe the story you told at one point. So this is actually probably the more operationally important topic, but something as the technical treasure of Gust, I care near dear in my heart is actuals, and actually looking at your model and your revenue lines and truing them up and making better informed decisions. So as always, feel free to use the Q&A throughout or the chat, and I will interrupt Logan and surface up some stuff as is relevant, and we'll definitely have time for Q&A at the end. And yes, we record this. Yes, we'll share out a link and all the resources and the cool stuff that they post in chat. Jimmy as well. I'm sure he's going to be here helping me out. And without further ado, take it away, Logan.
Thank you very much, Ryan. Okay, so I'm going to jump right in here and I'm going to share my screen. So thank everybody for joining us for today. How to leverage a financial model to supercharge your business. So as Ryan was saying, this is kind of the other side of the coin whenever it comes to financial modeling. So a lot of people, whenever they first build a financial model, whenever they first get introduced to the concept of financial modeling, they do it for one reason and one reason only, and that's usually because an investor asks to see their projections. They want to say, how much money are you going to be making? How are you going to be spending the money? How are you going to be growing? Like, show me your 5-year pro forma, show me your 5-year projections. This is pretty much everybody's jumping off point whenever it comes to building a financial model. And there's a reason for that, right? I mean, like it's very important part of the fundraising process, being able to show that mathematical narrative to your business. But the reason that investors ask for that is not to give you busy work, and it's not for you to try to pitch your business in a different, more nuanced way. They do it because there's meaning to these numbers. There's a reason to put these together, not just for fundraising, but operationally as well. It's a great way to set goals. It's a great way to communicate vision. And if you just set a goal and then forget about it and never go and revisit it, then you're probably going to miss that goal, right? So the best way to adhere to goals, the best way to understand how you're going to be able to achieve what you've set out to achieve is to measure and track and correct if you start to get off of track. And that's what we're going to be covering today, is how to take that financial model that you're likely using for a fundraise and actually use it to, as the title implies, supercharge your business, to make your business better, to level up as a founder, to level up as a team, to level up as a company. That's really what we're going to be covering today. So this is very important, and it's something that, I hope that if I can impart one piece of wisdom to you all from this conversation, it's just don't ignore the model after the fundraise, right? Just pay attention to it, use it to make good decisions. And I'll show you how to do that here today. Okay, so just to talk about what gives me the right, who I am, why you should listen to me. So you can ignore this guy here on the left-hand side of the screen. He's not important. He's just my co-founder and the CEO of the company. But I am Logan Burchett. I'm co-founder, COO over here at Forecastr. So, I've been a fractional CFO for a number of years. That's really where I learned the ins and outs of financial modeling. It's where I learned the ins and outs of FP&A. And I personally spent a lot of the early parts of my career building models specifically for fundraising, just because founders would ask for that. They would need a financial model for fundraising. And then it was after I started transitioning more towards a fractional CFO and not just an analyst that I realized, wow, this stuff is amazing, not just for communicating vision, but literally for running your company, right? So I actually have some in the field experience when it comes to this. And I've firsthand seen a lot of the benefit, not just from founders that I've been advising, but for my own company, because we do everything that I'm going to be talking about today for Forecastr. So build a bunch of financial models. I've also sat on the other end of the table. I've been a fractional analyst for a variety of different VCs in the past life. And fun fact, I actually helped manage Kentucky's pension fund in the early part of my career. So I managed about $16 billion, which is kind of a fun fact, and it sounds a lot cooler than it is. In reality, I just really manage the S&P 500. So what is Forecastr? So Forecastr is it's an alternative to Excel whenever it comes to building and managing financial models. So really what we've done is we've taken Excel, which has been the dominant form of building financial models up to this day, right? Ever since the 1980s. And we've built it into an online integrated web app. And we've designed it for one purpose and one purpose specifically, which is financial modeling, right? So if I can kind of explain the value of financial modeling, if you look at every larger company, every like publicly traded company or even larger middle market company, and you look at the organizational structure of these companies, you're going to notice that they all seem to have this one department in common. It's a department called FP&A, right? That stands for financial planning and analysis. So it's different from accounting, right? It sits on the other side of accounting. It's called financial planning and analysis. So the entire purpose of this department is to take all of the work that the accountants have done, square it with all of the other data that the company has, put it together in the form of financial models and projections, and use the output of those models to make really strong financial decisions for the company, right? It's not to pitch investors necessarily, although that's a part of the job, but it truly is understanding your business better and making good decisions for your company. There's a reason that this is a ubiquitous department across pretty much every successful company out there, because it works. It's very, very powerful. It's the office of the CFO, if you've heard that phrase. So what Forecastr is doing, really what our vision is as a company, is to take that department that has traditionally been enjoyed by much larger companies and bringing the value of FP&A down the line to where if you're a startup or you're a small to maybe medium-sized business, you get the same level of value that these larger publicly traded companies have, but you don't have to go out and hire a CFO or a team of analysts. Our software and our analysts will help you get there. So if you're interested in Forecastr, figuring out if it's a good fit for your business, Jimmy on our team is going to put a link in the chat that you can use to get a hold of somebody from our team. And we can walk you through what the future is going to look like for you if you choose to come on board with us. But that is enough of me talking about Forecastr. Now we're going to dive right into the content, and I want to start talking about how you can, once you have a financial model built, use it in order to supercharge your business, to really level yourself up, right? So to orient the rest of the conversation, what I want to do is I want to break down a financial model into 4 key overarching areas. So those of you all that have seen financial models, and been scared away from them, maybe you're probably thinking of these big, massive Excel spreadsheets with 50 tabs that are all over the place, right? Financial models have a lot of moving parts, a lot of moving pieces. So just to keep the conversation crisp and clear, we're just going to talk about 4 different sections that all fit together that are going to produce these financial models. So the 4 separate sections that I'm talking about, you can see on the screen, but they are if I can move this out of the way. So they are going to be the growth plan, the revenue plan, the expense budget, and the capitalization plan. So I'm going to talk about these at a high level on this slide, but we're going to spend really the rest of the presentation going through piece by piece and talking very in depth about what each of these mean and giving specific examples of them, right? So starting with the growth plan, this is going to be the plan that's going to articulate the strategy that outlines how you're going to be acquiring customers, right? So how are we getting new people in the door? How are we actually getting people to buy what we have to sell? Now, you'll see this in a second when we go through an example, but this should be very, very detailed. You should have individual targets for each individual, not just total allocation of customers, but the specific channels that you're going to be using. So that can be things like direct sales, Facebook, conferences, things like that. So again, we're going to go through an example of that, but it should be very detailed. It should be very precise in what you hope to achieve. And that's the growth plan. But coupled with that is going to be the revenue plan. So that kind of sits on the opposite side of the growth plan. There's a very distinct, very important difference whenever it comes to the growth plan versus the revenue plan. So the growth plan is articulating, how am I getting people into the door? How am I getting people to buy what I have to sell? The revenue plan is going to articulate, how do I turn those customers into dollars, right? So once I've got somebody in, once I've gotten a share of their wallet, you have to have a plan for how are you going to actually, right, take those funds and what is that going to look like? So how much is this customer going to be paying you? How long are they going to be sticking around, right? Like, what is the churn rate going to look like? So how long are you going to keep them as a customer? Are they going to be upsold into higher tier packages? Are they going to be downgraded whenever their, funds get tight, perhaps? Just having a plan or a set of goals around this is going to be very, very important in understanding how you're ultimately going to achieve the goals that you have set in aggregate for the company, not just in the next couple of months, but in the next several years, right? Your expense plan, you'll notice I called this the budget because I feel like that's what a lot of people think of it as. It's really just a plan for how you're going to be spending your money. So, this is a very, very important section, and it's probably the most straightforward section on this slide because we can all think in terms of budgets. A lot of us have personal budgets. I know I do. I use Mint for it. But it's something where if you're going to ensure that you're going to maintain healthy runway, one of the easiest ways to do that is just to make sure that you're sticking to a budget, right? You put together a plan for this is how I'm going to be spending this money, and this is how long I can make this money last. But if you just put that in a spreadsheet and don't look at it, it's very easy to overspend, right? So this is something that you put together and you track against just to make sure that you are not going to run out of cash unawares. And then the final section is going to be the capitalization plan. So this is essentially a strategy that ensures that the company doesn't run out of money. So it's going to include, your plans for raising equity, your plans for raising debt, and it's going to help you understand what the best and most efficient way is to get cash into the company is. So it is truly what it sounds like. It is a way to capitalize your business. And it's going to be in a banded time frame, which we'll see here in just a second whenever we go through the rest of these slides. So I want to jump into the first example of this, which is going to be the growth plan. Now, what you'll notice right off the bat here is that we've separated the model into quarters, right? And you can kind of ignore these dates because I know that we're already past May, but you can kind of get the sense of what's going on here. So you're breaking your model down into quarters, and then you're subsectioning those quarters down into months. And you're going to do this for each section. This is not just for the growth plan. You're going to see the same thing on the revenue plan, on the expense budget, and then on the capitalization plan as well. Now, the reason that we do this is if those of you all that have spent any amount of time looking at the Entrepreneur's Operating System, EOS, or are familiar with the framework of OKRs, Objectives and Key Results, essentially it's a framework that we like to adopt in financial modeling, or at least an aspect of it, where we set specific goals within a banded time frame. And in this case, the time frame that we recommend is a quarter. So basically you're saying, this is what I hope to accomplish within the next quarter. This is how that's going to fit within the broader vision of the company, and the broader vision can be shown in a 5-year forecast. And then these are the split goals within this quarter, which are shown in months. So essentially, if I'm looking at Q2 here, because that's kind of the active quarter on this slide, I've got specific goals for how many customers I hope to bring into the business within that quarter. And then I have split goals that are, specific to the growth funnel and specific to the month that I can track against in an effort to build towards my ultimate goal, which is the total number of customers that I'm getting within this quarter. So basically the framework that we like to use is forecast for the 5 years, but focus specifically hard on this quarter, because that's really where you're focusing right now. Have split goals within that shows I'm going to do this on a month-to-month basis by these individual channels. And then you're going to measure against those as the quarter is playing out. And this is the best way to operationalize a forecast because it does two things. It allows you to be nimble because you're able to adjust the forecast on a quarter-to-quarter basis, but it also keeps you honest in that I'm tracking against what I said for the entire quarter, right? So if I'm digging into this hypothetical company, it's relying a lot on social media advertising and influences in order to grow. So, we're sitting here, we're in May of 2023 on this slide. So if I'm in the current quarter, so Q2, you can really get a sense of how the growth strategy of this company is playing out and the areas that we need to focus on as managers and operators of the business in order to drive new customers today, right? So it doesn't make sense, given our plans, to spend a lot of time doing prep work on conferences for this quarter, because we can see that we have a very small target for new customers in this quarter from conferences. We're only looking at 2 new customers for the entire rest of the quarter. But now if I compare that to my Facebook advertising strategy, I need to spend a lot more time there in order to make sure that we hit the mark. Because if I'm not spending enough time focusing on Facebook and we end up coming short of that goal, then we're going to be much more likely to miss our revenue forecast, since that's a much larger percentage makeup of the total number of customers that we're expecting to get in the quarter, right? If I do spend a lot of time and I really, spend tons of energy and focus and all of that on Facebook strategy, and we still come significantly under forecast, that's a signal that we either need to, well, like really do a retrospective and understand what went wrong and like do a deep dive and try to fix the problem before it gets even worse. Or perhaps we say, Facebook's not as strong of a strategy as we originally thought. Let's look at other avenues for growth. Let's see if we can find another customer acquisition funnel and then really dig into that, right? So it's really what you're doing is in an effort to optimize your business, you set very specific goals and you focus really hard on trying to hit those specific short-term targets. And these targets, they fit into the vision of a larger 5-year forecast. So it all fits together. It's just in order to, what's the analogy? It's like, the way that you devour a whale is one bite at a time. Well, that's basically what you're doing here is you've got the whale, which is a 5-year forecast, it's a 5-year vision that builds up. But the way that you execute that vision is 1 month at a time. And that's really what you're doing here is you're just making sure that you're on that trajectory that you set that's going to get you to that 5-year vision. Right. Another thing I'll call out on this slide is it's not just helpful for operating in the moment, but it also shows you what you should be preparing for down the line. So if I'm looking at this plan, while we have a diversified way that we're getting customers, there's this one absolutely massive comparatively component of future growth, and that's coming from influencers. You can see that that's happening in Q3. In July, we're hoping to get 90 customers from influencers, right? So since it's seeming like this is going to be, at least expected to be, such a massive part of the company's future growth, if I'm a manager and an operator or an employee of this business, we need to focus hard on this. We need to ask ourselves, what do we need to do in Q2 to ensure that this influencer initiative, this new growth channel that we're unlocking, goes off without a hitch in Q3, right? If that flops, then we're going to have some serious issues with our business because it's such a massive piece of our growth funnel. So it's a great way to ensure focus. It's a great way to ensure clarity amongst your team. And it's a great way to quantify what success looks like in a very real and a very tangible way so that everybody understands what to expect. So to continue along here, right? In order to really operationalize this, you want to track down to the different segments of your customer acquisition funnel that you plan to hit in order to try to optimize how you're going to be achieving these goals. So just to kind of show you what I mean by digging in to a specific example, in this case, we'll use direct sales. We can see that, at the highest level in May, we're forecasting that we're going to get 4 new customers from this growth channel. We're getting 4 new customers from direct sales. But you want to push in further and say, well, how are we getting those 4 customers? If you really want to operationalize it, how are we getting those 4 customers? So in this case, we have a salesperson and they're going to start by reaching out to 100 people. And that could be calling, sending emails, whatever process makes sense for the company. Then we're going to say of those 100 outreaches, our goal is to get 10% of them or 10 to agree to an in-person meeting. Right. From there, our goal is to get 80% of those folks, which would be 8, to follow up with the demo, of which we hope to convert 50% of them or 4 into a paying customer. So by setting each individual stage, individually, we can figure out where in the process to optimize. And whenever it comes down to breaking these sections, because you can go very, very granular, right? You can keep going deeper and deeper and deeper. Our recommendation or a good rule of thumb is to track down to the controllable metrics. So, in this case, the salesperson could always reach out to more leads. So if I'm looking at what can I do in order to drive this further, you could always reach out down to more leads. You could follow up in a different way or change cadence or anything like that. You just want to break it down into the things that are the most telling into the health of that individual funnel. And then you can choose which things are inputs and which things are going to be derived from those inputs, right? So that you can really get a deeper understanding of where are the levers? If I'm going to grow this business, where are the levers and what goals can we set with those levers in order to make sure that we have the highest probability of success? And once you've set this, right, once you've spent some time with your team to set these goals and get buy-in, these are, like I said, basically going to translate into your KPIs or OKRs or whatever kind of goal setting framework you have for that quarter. So if I want to continue with that direct sales example, what we're looking at now is going to be a retrospective that we do in June once May has come and gone. So what we're going to do once the month has passed is we're going to see how our salesperson compared to the targets that we set together in May. And by the way, I'll note here that whatever you put in the forecast, whoever's responsible for that area, you want to get mutual buy-in for, right? So ideally, once we've kind of set these targets, we're going to sit down with the person that's operating this, and we're going to say, this is what we expect. Is that reasonable? Is that realistic? Can you commit to trying to hit these targets, right? That way, you know that you're not setting unrealistic stuff for your team. So if we're in June, so May is come and gone. Now we want to do a forecast versus actual. So in this case, if we're sitting down and analyzing this, we fell short of our outreach target, but we still hit our targets for companies making it into the first meeting, right? So even though we fell short of that top part of the funnel, we're still good in the second step of the funnel. We fell short in demos and then the final conversion down to the new customers. Now, what this tells us is that it's really the last two steps in our funnel that need the most work. And particularly, it's converting from demo down into new sales. So, in this case, there's a lot of things you can do once you have that information. You can look at how your demos are run. You may want to spend time adjusting the cadence or, spend more time customizing the demo to that client, put in more of their data, put in their logos, things like that. Doing this in this way with this process makes you really think critically like this and spend more time optimizing each step in the funnel until you get it just right, right? If you don't do this, then one of the things that you're going to be at risk of is just telling your salesperson, well, just reach out to more people, right? We missed the sales goal, just reach out to more people. And that may increase your final sales, right? That may be a good approach to doing that. But the problem is, if you look at the goals that we set, we got buy-in for, it's actually not the top of funnel that's the problem, it's the bottom of the funnel. So essentially what you're going to be doing is you're going to be dumping more leads into a leaky funnel. So this is kind of the way to really spend time thinking critically like this and then supercharging it to where your funnel is very, very strong and you've got really good buy-in and all of that. Once you're past this, once you've done your forecast versus actual, you can choose to either keep your targets for the next few months, or if you learned anything and you feel like you need to adjust, then you can. And this is how you get really good, strong, and accurate forecasting. Okay, so that's the growth plan. So now I want to talk about how those growth targets that you set in the growth plan get translated directly into the revenue plan. So this is going to be, I will note, completely customized to your business. So what I've got on this slide here is a revenue plan for a subscription business model. If you're an e-commerce business, this is going to look a lot different. If you're a hardware business, if you're like an enterprise sales kind of SaaS business, this is going to look a little bit different. So our challenge to you all is spend some time really thinking about your revenue formula and how you're monetizing your customers, and then build something custom for you so that you can actually put a plan together. And if you don't know what that looks like, get in touch with us and we'll help you. But you can see that this green box down here at the bottom, what I'm doing is I'm taking the new customers that I got from my growth plan. And if I actually scroll back, you'll see that these bottom numbers are the exact same, right? I'm just literally plugging these directly into my revenue formula. And these new customers are going to drive the calculations that end up creating my revenue targets for the coming quarters and the coming years, right? The reason that it's important for these two things to fit together is there are many ways that you can hit revenue targets, right? It's not just sell more deals, although that is one way to hit a revenue target. That's one way to grow, is just literally sell more customers, but it's not so simple as that, right? There's a lot more nuance to it than just that. I could also increase prices, right? Or I could increase the ACV. I could try to upsell current clients. I could try to reduce my churn rate. All of these things are going to work together to increase your revenue. This is something that we've talked a lot about in past events, but really to be a great operator of a business, what your job is not just to, lead the team into trying to drive revenue and things like that, but it's also to do the work to understand which inputs are the most sensitive to driving revenue and then focusing on those inputs, right? You may find that you have maxed out your team on growth and there's really no more low-hanging fruit that you have in order to bring new logos in the door, to bring new customers in the door. And that might be okay because you may say, look, I can't get any new customers. I've played every card that I have there. But what I may be able to do is, increase prices or maybe add a new product, a net new revenue stream that then I can go to these customers and then upsell them into, right? If I have aggressive revenue goals and I'm saying I've got to double revenue or triple revenue this year from last year, and I feel like I can't do it by getting a certain number of new customers in, then I may want to look at, what that looks like, adding new products or things like that, reducing churn, things like that. So, my point with this slide is just you need to set specific goals, not just for new customers, but for every input that impacts revenue. For a subscription business model, there's going to be three main inputs that we need to focus on. It needs to be the number of new customers, which that comes from the growth plan. But then it also needs to be churn rate, which is basically a fancy way of saying, how long are these customers going to be with me once I acquire them? Is it 6 months, 8 months, 12 months, whatever, and trying to elongate that as much as possible. And it's ACV or price, right? How much are these companies actually paying me? I may be able to increase that, right? I may be able to sell them something new, or I may be able to increase wallet share. All of those are going to work together in order to increase revenue and hit your revenue goals. So just to reiterate, have a plan and goals for your team for acquiring new customers. Once they've been acquired, you really need to have a plan and set goals with your team for how you're going to be monetizing them. So churn rate goals, price goals, or depending on what your business is, whatever the goals look like, it's going to be really important to make sure you have them in order to hit these targets. So now I'm going to move into the cost section of the model. So we're in the third section. This is where you're going to create a budget.
Before you jump into costs, we had a good question. We get this every time. On the previous slide, it's assuming a subscription-based model or a single revenue stream. What happens if there's multiple different revenue streams coming into the company from possibly different sources, services, subscription, contract?
Yep. So this is the nuance of financial modeling. It's the nuance of forecasting, is because every business is different. That's why it's challenging to put a revenue plan slide on that fits everybody, is because everybody's revenue model is different. So what you need to do is you need to really think through the flow of funds for your company and how somebody goes from becoming a customer to actually paying you money, and then put split goals for that. So to kind of run through that example, let's say I get 10 customers, right? To keep the numbers even, I get 10 customers and I'm putting together a revenue plan. Well, I need to have a goal for how many of those customers of those 10 are going to make it to my high tier plans versus my low tier plans, right? So it could be as simple as 50% of them, or 5, are going to go to my high tier, and then 50% of them are going to go to my low tier. If I wanted to increase revenue, if I wanted to grow faster, yeah, I could get more customers and that would get me there. But I have another lever too, which is get more people on the high tier plan. Let's get that 50-50 and make it 80-20, high tier versus low tier, right? So what you want to do is you want to have metrics or goals that kind of lead into the different revenue formulas that then aggregate to total revenue, so that, I can just not only say I need to get this many new customers for this month or quarter, but also I need to get this many customers buying these specific plans at this specific price. And all of those, they all work together. They all fit cohesively to impact your revenue and build towards a revenue goal. So that's kind of a, it's hard to answer perfectly for everybody because everybody's a little bit different. But my point here is just think through the mechanics of how you get revenue from your customers. Build that, what we call a revenue formula, that mathematical kind of representation of how the flow works. And then you want to look at all of the inputs, all of the things you have influence over, and then set goals for each of those. Be that product mix, churn rate, price, what have you. You got to put goals together for each of them. Hopefully that answered your question, but I'm happy to go deeper if you have follow-up questions there. Cool. All right. So now we're moving on to the cost section of the model. So in this example, we're going to look at salaries and benefits specifically, mainly because this is almost certainly going to be everybody's number one spending category. So startups traditionally spend over 80% of their money on people, which makes sense because people are typically the most expensive thing that you've got for your business. So In your model, you don't want to just do this for people. You also want to have it for all other spending categories like rent, marketing, professional fees, all of that stuff. But likewise, what we're doing here is we're putting specific targets for everything that we're going to be spending money on. In this case, it's going to be specific targets for each position, which is going to impact our overall budget. So this isn't just new hires. So you can see here, we're expecting to increase the CEO's salary in August. And we're also going to be hiring a chief of staff and some sales and marketing folks. Now, each of these items is important for a variety of reasons. It's not just the cost impact. It's also important because there are specific things that are kind of associated with these hires that you need to focus on during the quarter. So if, for example, your plan is to hire a chief of staff in Q3, your team is going to have some prep work that you need to do in order to make sure that that happens, right? You need to write job descriptions, start interviewing, things like that. This is also, just like a communication tool for fundraising, a financial model is a great internal communication tool as well that helps you and your employees understand the vision of the company, keep you on track. So in this company, for example, they're planning on growing their sales team aggressively for the next several months. So what that tells me is that hopefully this company is past product market fit and they're trying to double down on sales and grow, right? They've got a product they feel like they can retain on and things like that. So now they're just trying to grow their customer base. So it's important in controlling costs, but it's also important in building towards an overall vision. And also it's very important in just making sure you're not overspending. Most of the companies that we work with, once we get under the hood, we realize that they're actually spending a lot more money than they think they're spending. Just because it's very, very easy to just not pay attention, just to put the credit card down after you've raised a lot of money. And then before you know it, your runway is way shorter than it was supposed to be. This is a great framework for making sure that you're on top of that and that you have an understanding of your runway and that it is, in fact, what you hope that it is. Okay. We have now arrived at the final portion of the model, which is going to be the capitalization strategy. So you're going to notice a theme here. It's all kind of built in the same way, but just like with the hiring plan, just like with the revenue plan, just like with the growth plan, in this case, you got specific amounts with specific dates for how much money you're going to be raising and what the terms of that money look like, right? So in this example, we're focusing on equity. So in this example, it says this company is hoping to close $1 million seed round by the end of June. Seed rounds have grown, I think, since this presentation was made. But in this case, they're raising $1 million seed round by the end of June. Now, in order to hit this, there's likely going to need to be focus tasks that need to happen in order to close this out. This could be things like getting wiring instructions out or ensuring that the cash hits the bank account, following up with investors, things like that. So there's likely good communicated things that need to be done in order to hit this goal of getting the money into the bank. But it also outlines a rough plan for future capitalization and making sure that the business never runs out of cash. So in this example, there's a Series A way off into the future. Now, that might not be for 18 or 24 months, but it's good to think through how future fundraisers are all going to fit together in this cohesive financial plan. So, for example, if in this model, we're projecting that we're going to raise a Series A in 18 months, and then at the same time, my revenue 18 months from now is only $50,000 of monthly recurring revenue, then I'm probably going to be in for a world of hurt because those two things don't jive with each other, right? Raising a Series A with $50,000 of monthly recurring revenue is probably going to be pretty tough, right? You would ideally have at least $100,000 of monthly recurring revenue if you're raising a Series A. In today's market, it's probably a lot more than that even. So, you just want to make sure that whatever targets that you hit, not just today, but way out in the future, whenever you're going to be executing on next large milestones like a fundraise, they all tell the same story. They all fit in the same narrative, and they all blend together in a way that if you step back and you look at the output of the model and you can say, yes, if we execute this, it's going to be successful, then it all comes down to execution because the goals have been set, expectations have been set, metrics have been set, you know what success looks like, and then all you have to do is execute, right? I say all you have to do is execute. That's really, really, really hard, as we all know, but you at least know what success looks like and your team knows what success looks like, right? Okay, so we've got about a little bit over 20 minutes left, which puts us at a good pace. I do want to spend some time going through our financial model to show you what I mean by some of this stuff, right? Like a lot of this stuff, whenever we talk about it in a webinar format, it's a little bit abstract. It's hard to kind of visualize how this can be put into place in a real live operating business. Well, Forecastr is a real live operating business. We do all of this. So I think it's good to be transparent, show how we do things here and how we operationalize ourselves. So you'll notice here that everything that I just talked about is built directly into our software. So I've got a customer acquisition plan that shows how we're going to be growing over time. I've got a revenue plan that's going to show how we're going to be monetizing these customers. I've got a people section and an expense section. Both of those two things work together to form my budget, which we talked about. And then we have the capitalization plan. They're called different things here, but we have equity and liabilities. This is going to be debt and this is going to be equity, so new investment. So I'll touch on at a high level kind of how we think through things over here at Forecastr, but you can see what I mean whenever I say I've got targets for how many new customers we're going to be getting on a month-to-month basis. Now you'll note here, just to give you some color, that this goes down from June 24 to 15 in July. That's not an accident. That's on purpose. We're going to be increasing prices slightly and spending a little bit more time with companies, our customers, starting in July. So we forecast that because that's a goal that we want to manage towards. But if I'm looking at June, this 24, we need 24 new customers in June. How are we going to be getting those 24 new customers? Well, one from organic, one from Google, one from webinars, 8 from strategic networks. We have split goals with individuals that are responsible for us hitting those. So, this one's a big one, the 8 from strategic networks. If I want to go in here and understand how we're going to be getting these, you can see that, in some cases, we've just manually overridden things, in our goal setting. But we've also got these blue inputs that show what our levers are in order to hit these goals. In this case, we need 200 partners referring us an average of 0.47 leads per partner. So we have an activation metric or an acquisition metric and an activation metric. We have to get these many people referring us companies. How many companies? Well, on average, 0.47 per. That's going to get us 94 people applying to work with us, 56 people we can make it down into deals, and then 8 of those people we can make it down into new customers. And you can see we've got this for everything. We've got this for every individual section. And we have representatives from our team that are in charge of each individual section. I can go through and tell you, okay, Michael's in charge of, the organic and the Google and the webinars, right? Strategic networks, well, that's Jeff from our team. Techstars, that's Steven, my co-founder. Referrals, you can kind of go through and understand who's in charge of what, and then they know exactly what they need to do in order to hit these goals, which is very important for transparency, right? Then once we acquire these customers, we go over to our revenue streams and we articulate how these people are paying us. So I can go in here and I can see all of the different kind of platform subscriptions that we have, and I can understand kind of what the different fees look like and what we're anticipating from a churn rate perspective, new customer perspective, price perspective, all of that stuff. It all fits together. And you can see that we have individual packages that we take these companies that we bring in, we split them up, and we have split goals. And we say a certain percentage, a goal of these customers are going into impress, a certain percentage of them are going into growth. Maybe we're going to be getting some partner subscriptions as well. You can see that they all kind of fit together in a cohesive way for us to set these goals. And they all fit together to put together our revenue targets.
So Logan, I think this is probably a pretty good area to highlight this. Montana has a good question in the Q&A. Yep. It's similar to Justin's question, but it's about different business units. So not only do they have different revenue plans, but can you think of an organization that might have different units or even a constellation of entities that run on different revenue plans and combine them into a financial forecast like this?
Yeah, it happens a relatively decent amount. So the best way to handle that is with, I'll show you kind of the functionality that we have in Forecastr, but you can actually group these together into categories, and then you can assign categories to different revenue streams. So like, for example, let's say that, one of my business units uses paid advertising to drive my e-commerce revenue stream. Well, then every dollar of paid advertising, every customer that generates, I can just point those customers to that particular segment of revenue, right? That particular slice of the business. And then I can repeat that for a different segment of revenue. So maybe I've got a different set of paid ads that are driving just my subscriptions, right? Those new customers are going straight to that revenue stream. So they're not being broken down by percentage. It's not like a certain percentage of my aggregate customers are going here and a certain percentage are going here. It's more like I've got these defined segments of my business for customer acquisition that are driving this segment of revenue. And those two things kind of fit together and they mesh together in that way. If they're distinct business units, another thing that you can do is just create a different entire financial model for them and then aggregate them together so that you kind of look at them individually and you can see, okay, this is this business, this is that business, this is that business, and they all fit together cohesively. So those are two different approaches that I would recommend there.
Awesome. And a quick product question, because I know you can be proud to answer this one. Is there any way to import this data, or is this just manually entered in?
Yeah, no, you can definitely import it. So like one of the great things about using Forecastr over Excel is that we can actually integrate with your data sources. So you can see if I click this button, this is integrating directly with all of my QuickBooks data. And I can even have a variance on here as well. So once I've set my goals, then I can say, okay, well, how did I actually do compared to these goals? And then this is a great way to just make sure that I'm not way behind on revenue or I'm not overspending or things like that. So you don't need to manually input data. We can just go ahead and directly integrate with all of your data sources.
And on the other end of that, do I have to make up every single one of these Forecastr projections all by myself?
No, you do not. So one of the things that I think is somewhat unique to Forecastr, one of the things that I think I'll give ourselves some credit. I think that we did this right when a lot of people didn't do this. We recognized very early on that if you just give somebody the keys to a financial modeling software and tell them to go off on their own and build a financial model, they'll make a mess of it, right? It's it's kind of a nuanced business function. So it's really hard to expect somebody that has no finance background to build and manage a financial model. This is something that Carta learned early on as well. There's a reason that Carta gives you a white glove onboarding is because if a founder goes in and they try to build a cap table on their own, it can be kind of tricky. Same deal with a financial model. So what we do is we pair you up with a financial analyst, and that analyst is going to help you build out these projections, help you manage towards these projections on an ongoing basis. So we've got the best of the best. Our analysts are awesome. I always joke, but it's not really a joke, that our highest rated feature is our analyst team because they're just so great. They're awesome to work with, and they're very, very knowledgeable. And they can help you build and manage this so that you don't have to on your own. So, yeah. Well, cool. I'll touch on these last two sections super quick. So we've got the people sections. This is just going to be me. I can show you that we have individuals with specific targets for who's going to be hired, what they're going to be making, things like that, and other things that we're going to be spending money on. They all fit together in order to make our budget, which is super, super important. And then you've got the fundraising section, the capitalization section that's going to be showing how are we going to be raising money? What is that going to look like? All of that stuff. And you can break it down into a seed round, Series A, Series B, all of that stuff that puts specific targets on the calendar for what you need to do. And they all fit together cohesively in the three financial statements. And you can see right off the bat, we're a startup, we're not profitable, we're burning money every single month, but that's okay so long as it fits into an overall vision that shows that we're not going to be running out of cash and that we're going to be funded all the way through to profitability. So it all fits together, right? Okay, so we've got 14 minutes left. I've got one more slide and then we'll open it up for Q&A. I want to talk really quickly about the cadence. So how should I look at this? How should I think about this? What should be the cadence of finance, right? So I broke this down into weekly, monthly, and quarterly. So once I've got these projections set and I'm kind of in the month I'm operating, weekly, we recommend that you just kind of peek into your KPIs and you see how it's trending for your monthly targets. We like to do this every week. So our team, we sit down every week. We look at all of the goals that we have set in the forecast. We look at how many new customers we've achieved to date, like on these individual split goals, and we'll say this one's lagging, this one's ahead of schedule. So it kind of like helps you align focus with your team to know where to push and, where you're ahead of schedule. So that's kind of like our weekly recommendation. Helps you keep track and make sure that you can real time react to what's going on in the market. Monthly, we highly, highly, highly recommend that you put together a monthly finance meeting with your team. So if there's one thing that is an action item that you all can all walk away from this webinar with, it's that take a 1 hour block, get your entire executive team and put a finance meeting on the calendar and have that be a recurring meeting. If you don't have a financial model, at least look at your bank account and look at how much money you've been spending and just get a good sense of runway and what that looks like. If you do this every month, you are almost guaranteed to not run out of cash unawares. I say unawares because you can still run out of cash. You can still burn more than you intend to, and you can still hit the fume date on your runway, but you'll at least see it coming at this point. You at least have the opportunity to course correct, and it really, really helps ensure transparency and accountability with your team as well. So monthly finance meetings are super important. If you do have a forecast, which we really recommend that you put together, do a forecast versus actual and do a deep dive into what went right and what went wrong so that you can just get smarter about your business. That's how you level up as a founder, is you set goals, specific goals in a specific time frame. And then once that time is come and gone, you do a deep dive on what went right, what went wrong, and then you adjust from there. That's how you continue to iterate and get better. Quarterly, once the quarter is come and gone, that's when you do a reforecast. So just as a reminder, you set your forecast at the beginning of the quarter in all areas of the business: revenue, growth, your expense budget, and then your capitalization plan. You've got your goals for that quarter. You track while you're in the quarter. Once that quarter's done, forecast for the next quarter and make changes based off of what you learned from the previous quarter. It's going to ensure that your assumptions are up to date. It's going to allow you to implement what you learned from the previous quarter. And again, it's going to help you level up as a business and level up as a founder. So that is all I got for you all, and good timing. We have about 10 minutes left. So I will end it here and just say that we do want to impart $500 off of your first year annual subscription. So that's going to be about 25% because our starting price is $2,000 a year. What that's going to get you is a 30-day onboarding with an expert analyst that's going to learn everything about your business, help you build out that financial model, and then you're going to have free support included in that as well. If you do need a fractional analyst or a fractional CFO or anything like that to help you on an ongoing basis, we do offer that as well. And we are, I think, the most affordable solution out there. We love working with startups, and this is what we do every single day. So Jimmy, if you haven't already thrown that link in the chat, you can do that again. If you want to get in touch with us, that would be the best way to do it. And with that, I will open it up and I will stop sharing my screen. I will open it up for Q&A.
All right, hang on. Let me get this set up here. I shared the link in the chat, although I think there are 2 links, but they might go to the same place. So I think we're good, Jimmy, as long as the one that I put in there works.
Cool. All right. Appreciate it.
If you don't have any open questions at the moment, we actually hit the number one ones that always get asked, which is QuickBooks integration in terms of multiple business models. The one thing I kind of wanted to bring up that often gets asked is about, so you have your forecasts, which you come up with your team. You even work with the Forecastr team to help you kind of level set that and get onboarded to it. You hook up your actuals, but what happens when you want to like make big decisions, you know, about potential future paths for growth, but you kind of want to see like, well, what would happen without really muddling the forecasts that you've been using, you know, say things are going well, but you want to seize opportunities rather than stay alive.
Yeah, big time. So yeah, let me talk about that for a second. I'm actually going to open this back up to help answer that question. So one thing that you're going to notice, this is our active financial model, right? This is what me and my team use to run the business. One thing you're going to notice is there's a bunch of different scenarios in here. One is called the active scenario. One's the $4 million raise scenario. We actually just raised $4 million. We're in the middle of closing that right now. You can see we have an increased price scenario, a Q3 goal scenario. So we have a bunch of different scenarios. One of the things that we like to do is we like to basically set our goals for the quarter and we lock them down and we don't touch them. And that is the, you know, operating, we got to grind on this. We got to hit our goals, that type of scenario. But to Ryan's point, if we wanted to do kind of like a one-off analysis, well, what would happen if we raised our prices? Well, what would happen if we hired this person? Well, you're not necessarily committing to do it, but you're just curious to learn more about your business. What we recommend doing is just going in here, cloning the scenario, and then doing whatever you need to do. And then that can just be kind of like your scratch sheet one-off scenario type of deal. One of the, if not the best, like use of a financial model, one of the best uses of a financial model is just that, just what Ryan outlined. So, one of the features that I like to show off with financial modeling the most is the ability to look at your inputs of your financial model and then vary them all in different degrees to understand what has the highest impact on your business. So, we've given this webinar before where we ask the audience, like, what do you think for a subscription business model, a particular subscription business model has a greater impact on your cash, your price, or your churn rate? And one way that you can answer that is you can vary each of them by 10%, increase my price by 10%, increase my churn rate by 10%, and then look at revenue. It will literally tell you what is more important between price and churn rate. It's one of those things that it'll help you identify the levers to focus on, but then it'll also help you understand kind of like the implications of different financial decisions or strategic decisions, so that like, what should I do in order to have the best outcome for my business, my investors, and my employees.
Well, I think that is also one of the benefits, or one of the few places that you can actually kind of like run a thought experiment without just making things up. I've seen this all the time, is usually when startups clutch on to something that is working, and valuable, it becomes really difficult to make your mind to change it, right? If you have a given market, if you have product in market and it has a price and it's selling, maybe it's not selling at the growth level you're shooting for, but it's selling, that kind of like, but like, should it be more expensive? Should it be less expensive? Should it be annual? Should it be monthly? What would happen if people did this? What would happen if people do that? You can like hand wring and customer interview and, internally talk about that with your team, but you're not really going to get, when you're asking about the uncertain future, you're not going to get like a real strong, yeah, let's do that. But if you can put it in the model and be like, hey, if these assumptions net out, is this exciting enough to take the risk? Is this worth being like, hey, let's take a quarter and focus on just making that change and like seeing what happens and like having the confidence that maybe it doesn't work out, but like we know the downside. What if doubling our price, quadruples our churn? Are we out of business? Do we lose all the money in our bank account? Or is it a mistake that we made? We can backpedal, we can get back to the old revenue model. But, if the upside is so big, like it's a really cool way to kind of, de-risk, or at least understand the risks of making changes like that, because they are often way down the line or often very counterintuitive in terms of fiddling with little numbers and prices and things like that.
Yeah, and to build off of what you just said, Ryan, like the other really powerful thing about it is it allows you to predefine what success looks like. So let's say, just to build off of that example, let's say that I want to raise prices by 50%, right? Okay, well, let's run that thought experiment. Okay, I'm going to raise prices by 50%. What are the things that are probably going to be affected by that? My churn rate's probably going to be affected. People are probably not going to stick around as long. My conversion rates are almost certainly going to be affected. I'm probably going to sell less if I do raise my prices. So what I can do using my financial model is to say, okay, if I raise my prices, what does the break-even point for churn and conversion rate need to be, right? Like, how far can churn rate go up? How much can my conversion rates drop? And I can understand what that looks like. Then what I can do is I can say, okay, I'm going to split test this. And I'm going to, now that I know what my conversion rates and churn rates can fall to, I can then, for the next 10 clients, 15 clients, however many pitches, pitch them that new price, see what is my conversion rate, what is my churn rate or whatever on that, plug those new numbers into the financial model. Is this better or worse? If it's better, execute. If it's worse, don't. And this is the type of stuff that we do all the time at Forecastr is we'll run a little, we'll have an idea, we'll put the theoretical numbers in the model. Is this interesting or is it not? Okay, if it's interesting, what does success look like? Run an experiment. If the experiment confirms where our assumptions were, then we run it out kind of company-wide. So very, very useful. This is why FP&A exists, and this is one of why Forecastr is a thing. So
Awesome. Well, I think that wraps everything, and we're almost right at the time. So, Logan, thank you very much for coming back. If this popped in more questions and you want to see more of this hands-on, we will have I believe, a financial model teardown event coming up in the next couple weeks, which rather than kind of explain the philosophy behind it and some of the more abstract principles of it, we literally take real financial models from out in the wild from our founder base, and we basically rate them. They even upload them to Forecastr and walk through them so that you can really see. It's really great for businesses of many types, because those questions always come up. It's like, well, what if I sell like containers, but I also charge for, I don't know, whale lessons, and who knows? It's like, oh, well, here's a business that actually does something similar to that, and you can help translate it and maybe bring it down to earth. Awesome. Well, any parting words from you two?
I got nothing. I just want to say thank you all again for coming. I really, really hope that you all learned something. And we give, like Brian said, we give these presentations all the time. So we'd love to see everybody coming back for the next one. So appreciate all of you all, and hope to see you again soon.
Yeah.
All right,
everybody.
bye.